Chipmakers powering the NASDAQ today. I'm Lisa Bernhard with Reuters, and I'm joined by Eric Lynch, Managing Director of Scharf Investments. Eric, we have chipmakers AMD and Nvidia hitting record highs today after TSMC, which is the world's largest chip maker, projected more than 20% revenue growth this year. Is this an AI-driven rally? What's behind this?
Yeah, great question. And this is a company that makes the chips for Nvidia, so it's a fantastic read through, Lisa. The 20% revenue guide for 24 was amazing, but I would just say, it needs to be in the context of revenues were down 5% for 23. So the base effect over 2 years is really only a single digit kind of revenue growth. But your question is a good one because management definitely articulated that this was being driven by the leading edge chips made for AI, the Nvidias of the world.
All right. On the flip side, healthcare is down today. Humana slid about 11% after forecasting higher than expected quarterly medical costs. Now, this is on the heels of United Health and CVS Health also saying the same thing. So explain to us the challenges of the healthcare sector right now.
Yeah, right now you've got basically, post kind of COVID pent-up demand occurring within the older clientele using the Medicare Advantage policies at these companies. And so the utilization rate's higher than anticipated. And that's what's happened is that's hurt their margins. So that's really what's impacted. Now, Humana is losing some share in Medicare Advantage. So this is, a Humana story. It's not hitting the others as hard. But what I would say, Lisa, is that remember that probably some of that utilization comes down as some of these pent-up elective surgeries kind of normalize following COVID. And then B, you've got the ability of the Humanas and other MCOs to reset pricing effectively year to year. So if utilization rates stay high, it's temporary because the companies will just reset the pricing.
Okay, so in terms of these two sectors, this is kind of the opposite of what we've seen so far in January, right? Like healthcare has led the way and information technology has lagged. So do you expect that they will flip back again?
That is the question we all want to know, Lisa. It's hard to say. Look, in perspective, last year, 23, IT was up over 50%. Healthcare was up 2. Year to date, healthcare is up about 2 until today. And so it's already approximated its 23 calendar returns. It just depends, I think, whether this is going to be a risk on or risk off market. What would determine that would be whether or not we enter into a real recession. Typically, after the Fed stops increasing rates, you get about 11, 12-month delay until you actually get the eventual recession historically. So that would put us into June because the Fed stopped hiking in July. We'll see. We're getting kind of mixed signals on the economy. Some of the prints are really strong. Some of them are fairly weak. Discover reported today and doubled their charge-off rate. So it's just hard to say what happens, but the opportunity and the defensive names is there because they didn't participate in the rally last year.
Okay, so sticking with tech, I want to talk about Apple because shares are up about 3% as we're speaking right now after B of A Global Research upgraded the stock to buy from neutral. That's its first ratings upgrade of the year. Its shares, however, have lagged the outsized gains of the others among the Magnificent Seven. What other average stocks has it lagged that might surprise investors?
Yeah, well, it was very interesting to look at the Santa Claus rally in the month of December. Obviously we're a couple of weeks removed now, but that month you saw kind of an interesting phenomena take place, and that was a transfer of market leadership from the Mag 7, which were only up 4% that month, and Apple was up only 1% in the month of December, to the kind of average stock of the S&P 500. So what I mean by that is the equal-weighted S&P 500, which had done almost nothing all year, was up 7% in the month of December alone. And just to give you some examples of names that you would never think about in this market environment where risk is so on, and tech and AI are leading market excitement. U-Haul. U-Haul, we all know U-Haul. They ship stuff from point A to B. This is not a sexy company. They were up 27% in the month of December. And so why was it up? Because it was just so darn cheap and it wasn't really participating in the rally year to date. and it's quietly amassed a very large storage business in addition to its trucking business. And so that business, I think, finally caught some interest among investors as investors were anticipating some Fed rate, cuts in 2024.
Okay, before I let you go, what have been the estimates for fourth quarter earnings and what are we seeing so far?
Yeah, it's pretty interesting. As investors have been celebrating this kind of dovish turn from the Fed the last couple of months, meanwhile, earnings estimates for Q4 have quietly come down from 8% as of September 30th to just 1% today. To date, we've only had about 7% of companies reporting, but right now we're tracking actually for about a 0 year-over-year EPS growth. Why is that kind of important to think about? Because baked into consensus estimates for calendar 24 are 12% earnings growth estimates. And so, we're going to be looking at these Q1 releases very, very carefully and looking for revenue guidance for calendar 24 to really see whether or not the 20 times multiple in the PE is priced correctly.